Nope. Well, then I'm going to call this meeting to order. And since there's only two people, it's 6 o'clock. I'm going to call the Food Service Committee meeting to order. Is there a quorum? Yes, because that's me alone. Approval of the minutes from the last meeting. I approve them. All in favor? Aye. Food service pension, there's one pension. I went through the numbers. They're perfect. So all in favor of approving the food service pension application, say aye. Aye. Motion for adjournment, a motion to adjourn. All in favor? Aye. And that's that.
It's all on mute.
Okay. So next, we will go on to the regular pension meeting on May 13th. One of the things is there's public access at this meeting. I don't know if there's anybody from the public here. So I will call the meeting to order. I'm not sure if there's anybody taking notes. Call the meeting to order. I'd like approval of the minutes from the February 12th meeting. Is anybody gone? Can anybody hear me?
Yes, can hear you.
Perfect.
Yep.
Any discussion on the minutes from the meeting of February 12th?
I'll make a motion to approve. It's Jim Hendrickson. I'll make a motion to approve.
Is there a second?
I'll second.
All in favor?
Aye.
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 No. Next is, are there any public comments? None heard. Next would be approval of pension applications. I don't know if Jerry is on. I have gone over the, I can read the pensions. If Jerry's not here. There's one, the first is Cynthia Mazzone. She has 19, 6 months of service, age 65. Her monthly pension will be $2,088.96. The second is Louis Mitchell. He's been here 30 years, 8 months. He is, here is 61, but he will be 62 when this pension occurs. So it's going to be regular. I'll discuss that later. His final pension is $36,792.
Frank,
Yes? Are you
this is
here?
Jerry. Yes,
Oh,
I
great.
am here. Don't steal my thunder, Frank.
I didn't want to do that. I didn't know you were here. Okay, go ahead. You go.
No. I didn't realize that I had my speaker on my phone, but apparently on the Zoom thing it was muted. So I apologize for that. I will pick up where you left off. So
Perfect.
You've gone through Cynthia Mazzone and Lois Mitchell.
Yes.
The next one is Lavetta Brantley, tax administrative aide with the city, 33 years, 5 months. She is 56 and she has an early pension. Her monthly benefit is $3,230.71, annualized to $38,768.52. Next, and just to backtrack for a moment, these were the pension applications that were prepared to be submitted at the March meeting, and of course, because of the cancellation, so we're just reporting these pensions now. Continuing with Stanley Schuler, a custodian with the Board of Education, with the city, 25 years and 4 months. He's 55, so his is an early pension. He elected option 3. His monthly benefit is $2,331.54, annualized to $27,978.48. And then the final pension for the month of March is Diane Albano, secretary with the Board of Ed, with the city, 24 years, 1 month. She's 63, so hers is a regular pension. She elected option 2. and her monthly benefit is $2,751.12 annualized to $33,013.44. Now, I don't know if Steve Browning is on the call. Steve, if you are, give a shout. Perhaps
I don't
not, because we did. Yeah, we did have
I did.
one for the.
Right, and I had opened a meeting with, I don't know whether you were on at the time, but I did open, because there's only two of us, and I did call a meeting to order for the food service. And,
Okay.
and it's been approved. I read it. and it's
Okay.
been
Very
approved.
good.
Okay,
Excellent. And then we have one application for the month of May. So this would be for this month's meeting. That will be Charles T. Verge, kennel keeper with the police department with the city, 39 years and 10 months. He's 61. His is an early pension. He elected the standard option. His monthly benefit will be $3,612.55, annualized to $43,350.60. And that's it for the month of May.
perfect. One thing I'd like to say is that the information and there is information here that's confidential and personal. I did go over these pensions and I contacted Jerry. There was one pension where the primary was a sister and the wife was the secondary, and but that was approved by the wife because there could be a conflict in the fact that a spouse in Connecticut has a right to the pension. And so unless there's a lot of discussion, we don't want to really go into many of the details that are in the pension. For example, who their survivors are, where they live, et cetera, et cetera, et cetera. That being said, if somebody would accept the pensions as they were mentioned just now, rather than go into any discussion, although I'm not denying anybody a chance to discuss items. If they are discussed, we might have to table them to a next meeting. Any comment? Got a call on you, Jim.
All right, motion to accept the pensions as presented. Let me see if I'm, yeah.
I'll second it.
All in favor?
Aye.
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 Opposed? No, okay. Thank you very much. I appreciate that. That makes it simpler for everyone. Is Britt here or Tom?
Hey, Frank. I think both myself and Tom are on the line and happy to dive into the executive summary. If everyone has that document that I sent around last week.
I do.
Great. And before I start, Ray, I believe you said we had a cutoff time at 7 p.m. I just wanted to confirm that that is the case.
Yeah, we have to limit, at least initially, limit the amount of time we dedicate to Zoom meetings because we have a limited number of licenses. That will expand as we go on, but I just reserved 1 hour for tonight.
Okay, great. So we'll plan to spend about 15 or so minutes on, what just happened, what we're going through, and then touch on the first quarter performance for the pension plan. Be happy to answer any questions along the way. I will begin on page 3 of the executive summary. I think, as you all know, what we've just gone through, what we're still going through is truly unprecedented. The global pandemic combined with the oil price war between Saudi Arabia and Russia led to extreme volatility in the global financial markets. I know we had a call last month as an emergency, and now that we're through the first quarter, we can see what happened in really, truly uncertain times. As you know, in March, many of us were issued shelter-in-place orders, and most of the economy came to a screeching halt. Unemployment has soared to over 15% through April, and I think everyone understands that the economic impacts of what is going on is going to take a lot of time to play out, and is very uncertain. GDP in the first quarter, which really only took into account the last 2 weeks of March when the economy really shut down, came in at minus 4.8%, following 2% growth in the fourth quarter of last year. And that's expected to drop significantly going into the second quarter. The pandemic really hit every sector in the economy around the world. The Federal Reserve and central banks really stepped in extremely rapidly compared to the global financial crisis, using a lot of those policies and expanding on them to try to issue financial stimulus into the markets to backstop the economy. On page 3, we have broad market returns. I think for the quarter, you can see the broad US market measured by the Russell 3000 down about 20.9%, bringing the 1-year return to minus 9%. Small caps down over 30%. It's actually the worst quarter return for the Russell 2000 in its history. Broad international markets were equally affected. You can see down over 20% developed and emerging markets as the risk-off sentiment and the flight to quality played out. You can see the Bloomberg aggregate up about 3.15%. With alternatives, we'll see how they play out due to their lagged reporting. I think you'll see the Cambridge Private Equity Index slightly positive. We're going to expect to see those returns come in over the next quarter or two as it hits the lagged reporting within private equity. On a lighter note, I would say the good news is from where we ended the quarter to where we are through yesterday, just to give you some perspective, the S&P 500 year to date through yesterday is down 10.5% versus almost 20% at the end of March. Small cap stocks measured by the Russell 2000 down about 23% versus almost 31% at the end of March. International markets, both EM and developed, down about 18%. And the Bloomberg aggregate up about 4.5%. So while today in the markets, I think you saw Powell's comments led to a sell-off, we have bounced back slightly. Things have certainly improved. April was a very positive month with equity markets in double digits. So we're a very long way from getting out of this, but that's kind of a background on where we are today and where the world has changed. I will turn ahead to page 9 to discuss U.S. equity markets. As you can see on the bottom of the page, every sector in the S&P 500 was negative. The energy sector down over 50% for the quarter as OPEC and Russia refused to cut their production. The financial sector down almost 32% as the Fed cut interest rates to 0. And one of the biggest, continuing trend that was really exacerbated in this volatile market was that growth outperforms value. So you can see the Russell 1000 growth in the top right in the blue bars, down about 14% for the quarter versus the value index down almost 27%. And the other point I would just highlight here is that during these uncertain times, investors really fled to the larger, more stable companies and really sold off the small caps, the more risky assets in the market. Turning ahead to page 10, international equity performance. Again, a lot of the same points as U.S. markets. The risk-off sentiment played out, and you can see that between the oil price war, and everything going on in the world, it really led to defensive sectors really outperforming. Broad US, ex-US markets down over 23%, emerging markets down about 23%. Growth outperformed value as it did in the United States. And I would just highlight that China was actually the best performing market in the entire equity universe, as they took swift action to shut down their economy. While we aren't necessarily sure on what reports are verifiable or not, the market thought that they were ahead and were able to take swift action versus the other economies. Within fixed income on page 11, investors fled to safe assets like US Treasuries. The aggregate held up relatively well, up about 3% for the quarter. But you'll see this in the performance. The plus sectors within fixed income, like high yield, got hit pretty significantly in the downturn. Investment grade, corporates, spreads widened, and returns were hit hard as the equity market plunged as well. On page 12, just wanted to highlight a few things on hedge fund performance. Norwalk has exposure to equity long short managers, ABS and Blackstone. And in the top chart, you can see long short equity managers down about 11%. These managers typically have some equity beta. Even though they go long and short, they're always typically anywhere from 20 to 50% long. So there is some equity beta there, and you can see that playing out in the 11% negative return.
Britt, excuse
Yes.
me for a second. I want to go back to page 11. You
Okay.
have on the fixed income, you have quarterly, and then on the bottom right, annual returns.
Yeah,
Is that for the last 12 months? How do you do
that's the
annual?
last 1 year.
So we're talking April 19 through March 31 of 20.
Correct.
Thank you.
And on page 12, the other piece of hedge funds I wanted to highlight, Norwalk has exposure to absolute return manager, UBS. So you can see the equity market neutral blue bar on the far left, down about 5%. On page 13 with private equity, I think we just wanted to highlight, I mentioned that it's going to take a couple quarters to see the impact of the pandemic really start to play out within private equity. I think one thing that we're trying to make sure our investors understand is that if anything, this is going to prolong the time frames of these funds. Norwalk has about a 4% allocation of private equity, and while capital calls are still coming in right now, they will tend to slow, and the lives of these funds will probably be prolonged longer than initially thought. And on page 14, we always like to show this chart to really instill the importance of being diversified across asset classes. And you can see the annual returns on the left side of the chart, followed by the monthly returns that we've just gone through. And while large cap equities are down significantly year to date, they're coming off a really strong run, and having exposure to a diversified bucket has really helped investors try to stay through this volatile situation we're going through. Any questions on the market environment before we touch on performance? Great. Turning ahead to page 16, just highlighting the asset allocation versus the target. Not a whole lot of surprise here, given what equity markets did during the quarter. You can see liquid real assets, which is really making up for the underweight infrastructure. So PIMCO is the liquid real assets that's overweight, 9% versus 6%. Global equity long short continues to be overweight, about 10.5% versus 8% target. And domestic fixed income, which was the best performer during the first quarter, now has about a 2% overweight, as absolute returns up about 1.5 points as well. And underweights, you can see really across the equity markets, international, domestic, and private, and infrastructure continues to wind down. Cash was at 2%. I know that we discussed having plenty of cash, and just wanted to confirm that there are no issues on that front or the city's needs.
Chitsame, are you okay? Is Chitsame here?
Hi, yes, I'm here. We are fine with cash. We'll get through to June 30th, and, you know, once July comes, we'll use the city's contribution to the pension fund cash to pay pension distribution.
Thank you.
Great. And importantly, I just wanted to say all these asset classes are well within their target ranges, which we'll see in a few pages. On page 17, we show the asset distribution. You can see total assets, 390.5 million. About 5.8 million was withdrawn from the plan to pay benefits. And the unrealized investment losses for the quarter, about 64.5 million. And you can see, based on the investment return in red, in that column is broadly from public equity markets. On page 18, we show the asset values versus the target, as well as the target ranges. So while there is a slight underweight to total equity, 61.2% versus, or excuse me, 61.1% versus 63%, at the expense of fixed income, which is slightly overweight, all the asset classes are well within their target ranges. On page 19 and 20, and 21 and 22, we show cumulative and fiscal year returns. I'd like to jump ahead to 24 and 25, where we highlight fiscal year performance and the attribution. Specifically on 25, fiscal year to date, so we're through 3 quarters as of March 31st, the plan returned negative 9.19% versus negative 6.45%. And what drove that underperformance is a few things. It's both active manager underperformance versus their benchmarks, and it's also some differences in asset allocation versus your target that detracted. So what helped? An overweight to PIMCO All Asset Fund. So as you know, PIMCO All Asset Fund has a broadly diversified exposures to things like TIPS and other inflationary assets. But it also has exposures to emerging markets equity, commodities, REITs. But the broadly diversified bucket within the PIMCO All Asset Fund outperformed public equity markets. So an overweight there did contribute to the overall return. Your absolute return manager, UBS, has done very well fiscal year to date, down about 0.6% versus almost negative 6% for its hedge fund benchmark. So really doing its job in a very volatile market, trying to eke out a return. And while it's not absolute positive, they have outperformed their benchmark by over 600 basis points. Your global equity long short managers have also done well. ABS is down about 3% fiscal year to date versus 9.5% for the benchmark. And Blackstone has just barely beat the benchmark, down about 9.1% fiscal year to date, but combined strong performance versus both peers as well as their benchmark. And lastly, on a positive note, your international equity manager, Silchester, has done extremely well. I believe they're up about 800 basis points for the fiscal year versus their benchmark. Artisan has slightly underperformed due to some exposures to airlines as well as natural gas and energy companies that hurt them in the first quarter. But broadly, they're both holding up, and Silchester's done extremely well. In terms of what hurt performance on a relative basis, PIMCO All Asset Fund is benchmarked to the Bloomberg 1 to 10 year TIPS index, which is not an investable index. And that index was slightly positive for the fiscal year, where PIMCO was down about 12%. So while it did not live up to its stated benchmark, the benchmark is not investable. So there is some noise in the attribution when it comes to trying to evaluate that piece of the portfolio. In addition, LSV significantly underperformed for the quarter and the fiscal year, while Columbus Circle has done extremely well. I know we had Columbus Circle in a few meetings ago, and they had an unbelievable quarter, up 800 basis points. But LSV, if you recall, deep value manager, and they have a slightly lower market weight, median market cap weight, and a slight overweight to financials, which really hurt both their relative and absolute performance. I think on a note from Callan, we still have confidence in LSV as a firm, as a team, in this strategy. Growth has outperformed value by a significant margin for the last 5-7 years, and we do believe that value will return at some point, and when it does, we believe LSV will be poised to succeed in that market environment. But they did not do well for the quarter of the fiscal year. And lastly, going into the first quarter, the plan was overweight to public equity, really driven by great performance over the last 5 years, and that led to some underperformance at the asset allocation level, as fixed income, where we were underweight, was really the best performer. And that's my prepared remarks in regard to the markets and the plan. Tom and I are happy to answer any questions.
Great. I understand in counterbalance, April was a record month for equities. What do you see for the rest of the quarter and the year? Do you think that's a slow growth and a bounce back? We're looking at the markets versus the economy. And I was just wondering what your perspectives are on that area.
Sure. Happy to start things off, and Tom, feel free to jump in if you have anything to add. I think our main message to investors is to stick to their investment policies. There's a reason that the amount of risk the pension fund is willing to take is the way it is, and the amount of asset classes in the portfolio. I think uncertainty would be the understatement of the century, and I would be wrong to think that what we've just gone through is over and we're going to bounce back, whether it's slow growth or whether it's not. I don't think that we are through even the beginning stages of seeing this play out in the economy as well as financial markets.
Yeah, this is Tom. I'll add to that. Can you hear me?
Yep, we can hear you.
Okay, thanks, Jim. So I think that first we have to disentangle the real economy from the markets. So they're not the same thing. Clearly, the economy is in a very serious downturn, and the prognosis for the economy is going to depend on how the pandemic progresses, what kind of medicines we are able to use, whether there's a vaccine. It's going to depend on the response from central banks. It's going to depend on response from the federal government and Congress. So there's that whole element of it. From a market perspective, we've seen a significant bounce, and I would say that that's been largely supported by actions that the Federal Reserve has taken. So there's some programs that they instituted that were resuscitations of 2008, 2009 programs like TALF, the asset-backed lending facilities. But they also have instituted new facilities that they had not used in the past, like a primary corporate bond and secondary corporate bond buying facility. And we saw significant moves in corporate bond markets before they'd actually bought a single bond through the asset manager they're using. So there's been a huge shift in sentiment from all the actions that we've seen from the Federal Reserve and other banks, as well as congressional action. So yes, we've seen a significant bounce, but there's a range of outcomes we could see from here based on, one, what's happening in the real economy, and two, the extent of further support that we get from the Federal Reserve and central banks. I'd say that Jay Powell, the chair of our Federal Reserve here in the United States, has been very clear about how aggressive he believes that the Fed should be, but also the federal government should be, and by that I mean Congress, to try and support the economy in this period. So we could see a range of outcomes in the near term, Henry, but we are long-term investors here. As Britt said, we have a long-term investment policy, and we have the ability to access liquidity in the program through the fixed income managers that we have. The portfolio is largely liquid, so the program is set up to be able to make its benefit payments for the participants and beneficiaries in the near and longer term.
Hey, Tom, or Chitsumi, out of curiosity, our cash levels with the balance that we have currently and the city's contribution, how are we as far as cash goes for the foreseeable future? How many months do you think we can go before needing to, get it from an asset class, out of curiosity?
Currently, we have about 4.5 in liquid cash, so that could get us through June. So in July, when I send the contribution, the city's contribution, I believe that would get us through 12 million. So we do 2.5 million per month, maybe
So six months more?
6 months.
So till December of this year, probably.
Possibly. Mm-hmm.
Since we're overweight in the fixed income area, Tom and Britt, would it make sense to rebalance some of that into equities? I know it's only 2%, but 2% of 87 million is how much? 17 million?
No, 2 million.
No, it's a
2
little
million.
under 2 million. But what we wouldn't recommend doing that now, Joe. We talked about this before, Britt and myself.
Yep.
And you're well within all your ranges right now, and we have had a significant bounce. This is looking at it as of March 31st. And so markets have improved a lot since then. We can look at it again with the April flash, and we have all those valuations in.
Okay.
And reconsider it then, but we don't think it's necessary now.
All right.
Tom, it's Jim. With all the money the Fed and the federal government are throwing into the economy, it's reasonable to assume that inflation is going to start taking off sometime. Would you agree with that? And two, would that impact our asset allocation in any way?
So the program for Norwalk is set up to have elements that are inflation sensitive. So the PIMCO-L asset portion of the portfolio, infrastructure is winding down, but PIMCO-L asset, that's the long-term objective there is inflation hedging, real returns above inflation. So there is a portion of the program that is designed to specifically address that. Plus, equities longer term should adjust for inflation. But it's funny that you bring that up, Jim, because I think it's a topic that can be intensely debated, and we've been debating it within Cowen, because there are forces that are inflationary, like the ones you mentioned. Our Federal Reserve balance sheet now, the number as of the end of April was close to $7 trillion. We're borrowing relative to GDP at rates we haven't seen since, I believe, the Second World War. So we are potentially going to see inflationary pressures from that. But then I contrast that with an unemployment rate that's almost 15%. It was 14.7%, as a force that's a huge suppressor of demand, if you will.
Yep.
So those are two major forces. Another one that I think longer term could be an inflationary force is supply chain adjustments. We were on a trend towards more protectionism. That's probably going to increase, I think. The supply chain stresses we've seen in this pandemic, I think that's going to be a response to that, of supply chains that are more domestic in nature. So I would say it's very much up for debate. And the recent readings, I know you look at this too, but the most recent CPI reading shows a decline in inflation. But I think intermediate term, we've got forces on both sides, and there's elements of the portfolio that are there to address it if we do start to see it.
Yep. Okay. Yeah, it's 2-3 years away anyway, but
Yeah.
long term, it's a long term issue. Agreed.
And Tom, I would raise the issue shorter term in the 6 to 18 month horizon. I'm very sensitive to interest rates. I'm always looking to borrow. We have a capital program. We just got our capital budget approved. From everything I've seen, and especially with the intent of Jerome Powell and the Fed, the predictions I've seen is 3 to 5 to 7 years of very low interest rates. So I guess the issue I would think of on the investment side is you have bonds with low interest rates, and if they don't go lower, there's no capital gain. So might we underweight over the next 6, 12, 18 months? We're now 2% overweighted. I get it, it's within range. I guess what I see, based on what Jim said, what Joe said, is short term, and I'm going to say 6 to 18 months. Interest rates are very low. The Fed is pumping things in. And then after that, maybe the inflation kicks in. Might that affect our investment decisions and rebalancing?
I think that we're well positioned from a fixed income perspective, Henry, with Norwalk, because you have two active managers. Prudential is much more conservative, and the portfolio needs that, right? You need to be able to access liquidity in the portfolio, and that's the best source of liquidity. So that's part of the program, and that's well diversified. It's not just treasuries and agency bonds, it's corporate bonds, it's mortgage-backed securities. So it's well diversified. And then if you look at a manager like TCW, which manages the other portion of it, that's called a core plus manager. So there's a portion of that where they can access areas like high yield and emerging markets debt. So their job is to balance the low interest rate environment that we're seeing in the safest securities like treasuries with finding yield and total return opportunities in areas like corporate bonds. So they actually shifted to a higher weight in corporate credit coming out of the worst of this in the end of March, because they saw the improvement in valuations, and two, that you could see the intervention of the Fed supporting corporate bond markets. So having those active managers helps access those opportunities. If you have just a passive index fund, you wouldn't be able to shift like that. And that's what a manager like TCW is doing. So we think that the way it's set up, if we looked at the weights today, we don't have them in front of us, but they'd be very close to their target. And given the near-term uncertainty we've been talking about, our recommendation is not to go below the 20% target that you have in bonds.
Fair enough, and I hear you. That makes a lot of sense. Let me ask one other question that comes to mind. Credit risk. People are predicting bankruptcies down the road. We've already seen the wave starting in retailing. There may be other industries, certainly oil and gas is getting hammered. I'm not too worried about the equities. I'm sort of more worried about the bonds where we might be exposed to a credit risk because we're trying to grab yield. And I just wonder, I assume the active managers are watching that all the time and they're rotating as they need to.
Yes, I think it's a very significant risk for the corporate credit market is insolvency of companies, bankruptcies. As you said, we've already started to see it, but you don't have dedicated high yield managers. You have investment grade managers. Prudential's only investment grade. TCW will do a little bit in high yield, but that's going to depend on market conditions. And they're a conservative core plus manager. It's vast majority investment grade. And yes, they are looking to increase yield relative to treasuries or even agencies for that matter, but they are having to balance that with risks. And it is going to be, to some degree, not completely, but to some degree dependent on the sector, right? Like energy, retail, those are some of the sectors that are under the most duress. Airlines. United Airlines just tried to issue a high yield bond and was not able to do it, as an example. But there are still companies that are extremely safe credit and are going to get through this crisis just fine. So they have to do that credit selection. That's what their mandate is. And we do think that TCW is a very good bond manager and is well suited to navigate what is unquestionably a very difficult environment for corporate credit.
Do you review their holdings only at quarter end, or do you look at it more frequently? So, for example, when three retailers go bankrupt in 3 weeks, or you have transportation, the rent-a-cars, the airlines, do you look in more detail in between quarters, or do you just wait for quarterly reports?
So it depends on the type of mandate it is. So this is a mutual fund. So a mutual fund is subject to SEC disclosure on holdings, but we do have regular contact with Norwalk managers through Britt and myself, the reports that we get and our communications with them, but also through our global manager research group. So Callan has an extensive global manager research group that is in regular contact with the bond managers.
Thank you.
Tom? Tom?
Yes. Hi, Frank.
Yeah, listen, LSV has underperformed for the last 5 years. Should they be you did say that Britt said he has confidence in them and your firm has confidence in them, but over the last 3 years, they've underperformed by 500 basis points. That's pretty substantial. And do you think at the minimum they should be on the watch list and maybe to review them as a firm? In 5 years of underperformance is a pretty long time also.
It is, Frank. It's not, we're looking at trailing returns, so it's not like they've underperformed month in, month out, quarter in, quarter out the entire time. But yes, it looks very poor right now. Britt mentioned this originally. For small cap stocks, this was the worst quarter in the history of the index in Q1. Then value did worse than growth, because think of sectors like financials and energy. being bigger weights than in growth, and then they're deeper value. So it was a very ugly period for them. And in general, we're at historical valuation dispersion between growth and value. So it looks really bad right now for them. At some point, this cycle will turn away from growth, and we'll see. We can't guarantee anything, but we expect to see a large recovery in value. I think it would be good. In normal times, we'd have LSV in to speak to the board, and we could arrange that via Zoom. We've been doing that with other clients because we can't have regular meetings, for them to speak directly. So to this question that was posed earlier about bankruptcy, it actually applies to equities too, right? And LSV has addressed this, saying that they're looking at all their holdings near term debt maturities. They're looking at their potential solvency issues. So they're very well aware and attuned to this issue. But I do think it would be good to hear from them directly when we can. We weren't intending to talk about the watch list because of the nature of this meeting, but if we do want to address that, I think that does make sense. The other thing I would raise is that without getting into the details here, is that their fee arrangement was changed. So that was addressed with them too. I'll pause there and see if you have any reaction to that, Frank, and how you want to proceed. If we're going to do another Zoom meeting next month, if you want to invite them.
I think
Well,
Frank's concern wasn't more on a absolute basis or growth versus value. I think Frank's looking at value versus value on a relative to how they're doing to the index, right, Frank?
right. I mean,
It's not a growth versus value situation.
right. It could be that there's maybe another value fund. I mean, to
Manager.
underperform by 500 basis points over 3 years is quite a negative.
I agree, Frank and Joe, and to try and explain it better, but by deep value, I mean, if we look at all the characteristics of their portfolio, price to book, price to sales, dividend yield, all these characteristics are deeper value than the index. So if we took the Russell 2000 value, we took their portfolio, it's going to look cheaper on all these metrics. Now, that's bad right now because of the dispersion between growth and value valuation. When we do start to see a recovery, whenever that comes, they're going to have the bigger recovery because of the nature of their holdings. That's what we would expect. Again, we can't guarantee that, but that's the expectation that we would have. And they're building their portfolio in that way. So they've got a very broadly diversified portfolio by sector, by individual holding. And then the idea is that as you see these valuations change, they'd sell, buy other securities, and they'd have, we would expect very good performance in that recovery. But when you have the indiscriminate selling and they're in that deep value category, they're going to look bad even relative to a value index. So it's having the patience to endure that. If the board doesn't have the patience to endure that, you'd want to look at other managers, but you also, even if you want to look at other managers, you'd want to do that, any kind of transition like that, away from the bottom of a trough, to not sell it at a trough.
The way we're looking at it, Tom, they only have 2% of the fund's assets, correct? Under $10 million currently. The small, right? Am I reading that right?
You're right.
Yeah.
They're at 2.5%.
Yeah.
Right. It's just under 10 million as of 3/31.
it's one of our smaller allocations to begin with an equity manager.
Right. It's a smaller part of the market. It's
I think-
typically been an area that's more inefficient where active management can work. Go ahead.
We have patience.
Yeah, agree.
Yeah, I'm not asking, I'm just,
We'll
I'm
give
not
him
asking
another month.
anyway. You know.
What did you say, Jeff?
We'll give him another month. No, I'm only teasing.
Tom, I believe that we were originally in March going to have PIMCO all asset come in.
Yes, we
And-
were.
And could we do a Zoom conference with them at the next meeting? I mean, they do have more money, you know.
It's a
they
much,
bring
much larger holding. Yeah.
Right.
Yeah, that was our intent, but because it was Britt and I wanted to go through the quarterly that Britt just went through, and the fact that this was limited to an hour, we were discussing it with Ray, and the consensus was we didn't have time to have PIMCO in. But since we're not going through the full quarterly next month, we could have PIMCO or LSV on the Zoom next month.
We may also be able to
I'd
get
rather have PIMCO, but
next month too.
Sorry, Ray?
We may be able to get more than an hour next month if I ask far enough in advance.
Okay, thank you.
Hour's good.
We should
Yeah, we
also,
like an hour.
Hour's good. No, I think
and
PIMCO,
they'll remember it when we're done for less than an hour. I get points.
you're banking it, Frank? Is that what you're doing? I think I agree with Jim about having PIMCO instead of LSV next month, if that's possible, Tom.
Yeah, so do I.
I agree.
Yeah, no, okay. Sounds good. We can definitely invite them.
Right. Of course, the other thing is, Ray, we would probably need to have an OPEB meeting soon, right? We didn't have one in March or April or May, so that we should be due for an OPEB meeting, wouldn't we?
I'll check. I don't recall when the last one was, but we can put one on the agenda for next time also.
Okay. Does anybody have any discussion or questions? Could I bank even another 8 minutes if we?
You're pushing it out, Frank. Move to adjourn.
Is there a motion to adjourn? Is there a second?
I'll second.
All in favor?
Aye.
Aye.
Opposed? Meeting's adjourned. Thank you, everybody.
Okay,
you.
everyone, have a good
Thank you.
month. Bye-bye.
Good
Stay
night.
safe,
Stay
everybody.
safe.
Thank you.